Have you ever wondered why two people can read the same investing book, watch the same financial news, even follow the same strategies, yet end up with completely different results? One grows wealth steadily, while the other loses money and gives up in frustration. The truth is, most people don't fail at investing because of lack of knowledge or opportunity. They fail because of psychology, the way emotions, biases, and habits influence financial decisions. And until you understand the psychology of money, even the best investment strategies won't work. Let's break this down into the key psychological traps that derail most investors. And more importantly, how you can avoid them. By the end of this video, you'll have a clear roadmap, not just for what to invest in, but how to think about investing so you can stay consistent and actually build wealth over time. The first reason people fail at investing is impatience. We live in a world where we expect results instantly. If you order food, you want it in 10 minutes. If you post on social media, you expect likes immediately. And that same mindset spills into investing. Many people buy a stock or fund and then check the price every single day, hoping to see quick profits. But the reality is, the stock market doesn't reward impatience, rewards those who can stay invested over the long term. Warren Buffett has a famous quote: "The stock market is a device for transferring money from the impatient to the patient." Think about that. The reason the wealthy often get wealthier is because they have the patience to let their investments compound over decades, while the average investor bails out after a few months of volatility. To avoid this trap, you need to reframe your expectations. Instead of asking, "How much can I make this month?" ask, "Where will my money be in 10 years if I keep contributing consistently?" That mindset shift is the difference between short-term frustration and long-term wealth. The second psychological trap is fear of loss. Behavioral economists call this loss aversion, and studies show that humans feel the pain of losing money about twice as strongly as the joy of gaining it. So when markets dip, most people panic and sell, locking in losses that could have recovered with time. For example, during the 2008 financial crisis, the S&P 500 dropped nearly 50%. Many investors sold in fear and stayed out of the market for years. But those who held on and even kept investing saw massive gains as the market recovered and eventually hit all-time highs. Fear of loss is natural, but it becomes destructive when it controls your decisions. The solution is to understand that volatility is not the same as risk. Markets go up and down in the short term, but over the long term, they trend upward. By reminding yourself that downturns are part of the journey, you'll be less likely to make panic-driven choices that derail your progress. The third reason people fail at investing is overconfidence. On the surface, confidence seems like a good thing, but in investing, too much of it can be dangerous. New investors often believe they can beat the market by picking the next big stock. They may get lucky once or twice, but eventually the market humbles them. Even professional fund managers with millions in resources and research often fail to outperform the market consistently. Overconfidence can also show up in risky behaviors, like putting all your money into one stock, leveraging with margin, or ignoring diversification. The lesson here is that humility pays. Instead of trying to outsmart the market, use strategies that have worked for decades, like investing in broad index funds, dollar cost averaging, and maintaining a diversified portfolio. You don't need to be a genius to build wealth. You just need to avoid the overconfidence trap. The fourth psychological trap is herd mentality. Humans are social creatures. We look at what others are doing and feel safer copying them. That's why bubbles form. Think of the dot-com bubble in the late 1990s, or the crypto hype in 2021. People saw others getting rich and jumped in without understanding what they were buying. But when the bubble burst, many were left with huge losses. The problem with following the herd is that by the time everyone is talking about an investment, it's often too late to profit from it. The wealthy avoid this by sticking to their plan, not the crowd's emotions. To protect yourself, focus on your long-term goals and filter out the noise. Ask yourself, If nobody else was talking about this investment, would I still buy it? That single question can help you separate hype from real opportunity. The fifth reason most people fail is chasing perfection. Many new investors waste years waiting for the perfect time to start when the market dips, when they get a raise, when the economy improves. But here's the truth: there is no perfect time. The best investors succeed not because they timed the market perfectly, but because they spend more time in the market. If you keep waiting for the ideal moment, you'll miss out on years of compounding growth. To overcome this, commit to starting small and consistent. Even investing $50 or $100 a month builds momentum and gets you in the habit. Once you start, you'll realize the most important factor is not timing, but discipline. The sixth psychological reason is a lack of clarity. Many people invest without a clear goal. They hear about stocks, crypto, or real estate and think, I should probably do that too, but they don't have a plan. Without a target, it's easy to panic during downturns or switch strategies constantly. The wealthy approach money with intentionality. They know why they're investing, whether it's for retirement, financial independence, or building generational wealth. That clarity keeps them grounded when emotions run high. To apply this yourself, define your investment goals clearly. Ask, what am I investing for? What's my timeline? What level of risk am I comfortable with? When you know the answers, you'll stop treating investing like a gamble and start treating it like a strategy. The seventh trap is neglecting education. Investing is one of those fields where a little knowledge can be dangerous. If you only skim headlines or watch short clips online, you may feel informed but lack the depth to make sound decisions. This is how people fall for scams or overly risky investments. The wealthy never stop learning about money, markets, and financial behavior. That doesn't mean you need a finance degree, but it does mean committing to continuous learning. Read books like The Psychology of Money by Morgan Housel, follow credible financial educators, and understand the basics of how markets work. The more you learn, the more confidence you'll have to stick with your plan, even when things get tough. The eighth reason people fail at investing is emotional spending. This might not sound directly connected to investing, but it's actually critical. If your lifestyle constantly expands with your income, you'll never have enough left to invest consistently. Many people earn more as they grow in their careers, but they also spend more on cars, vacations, gadgets, leaving little room for wealth building. The wealthy, on the other hand, practice delayed gratification. They don't spend every extra dollar they earn. They invest a portion of it, so their money works for them. The key takeaway: control your spending so you can invest regularly. Without discipline in your daily finances, even the best investment strategies won't matter. Finally, the ninth psychological reason is giving up too soon. Investing can feel discouraging at times. Maybe your portfolio goes down, or you don't see results as fast as you hoped. Many people quit after a few setbacks, telling themselves investing just isn't for me. But wealth is built through consistency over decades, not weeks. Imagine planting a tree and digging it up every few months to see if it's growing. You'd kill it before it had the chance to mature. The same is true with your investments. You have to give them time. The wealthy understand this and stay the course, even when it's boring or uncomfortable. That's why they win in the end. So, why do most people fail at investing? It's not because the system is rigged or because opportunities don't exist. It's because of impatience, fear, overconfidence, herd mentality, perfectionism, lack of clarity, poor education, emotional spending, and quitting too soon. If you can recognize these traps and adjust your mindset, you'll already be ahead of the majority of investors. If you found this video helpful, make sure to subscribe to Property and Profit for more clear and beginner-friendly insights into building wealth through smart investing. And if you know someone who struggles with the psychology of money, share this video with them. Might be the mindset shift they need to succeed.